Welcome, fellow curious minds, to The Deep Dive.
Great to be here.
Today we're diving into something I find fascinating. How does well, a relatively small company, right?
Yeah.
Operating out of Denmark, how do they become such a critical piece, almost indispensable really, in this huge global high-stakes world of advanced therapies? Cell and gene therapy.
Yeah, you'd think it's all dominated by the massive pharma giants.
Exactly.
Yeah.
But sometimes the real power, it seems, lies in the tools, the precision tools that actually enable those giants.
It's a fantastic question, and it really is a masterclass in strategy when you unpack it. Today, we're going deep on ChemoMetec A. They're a Danish life sciences tools company, and they've carved out this incredibly unique and powerful position. They are, I think it's fair to say, a niche leader in automated cell counting.
A niche leader, I like that.
And understanding their story, it really gives you a shortcut, to being genuinely well-informed about this intriguing player in the whole biotech space.
Right. So our mission for you today is pretty clear. We want to unpack ChemoMetec's unique razor and blade business model.
Yep, the classic.
We want to understand their competitive advantages, which sound pretty formidable, analyze how they handle market cycles, that financial resilience piece, and then peek into their strategic future.
And we've dug through a whole stack of materials for this: investment research, company reports.
All the good stuff.
Yeah, trying to pull out the really important nuggets of knowledge and insight for you.
And get ready, because there are some surprising facts here about just how fundamental, how critical, simple, accurate cell counting actually is.
It sounds basic, doesn't it, counting cells? But it's foundational for developing these life-saving therapies.
And why does that seemingly simple process create such intense customer loyalty and such a, durable business model?
Exactly. It's about trust, precision, and the realities of bringing advanced medicine to patients. It's a great story.
Okay, let's get into it. Who is ChemoMetec? You said Danish?
Yeah, founded in 1997, based in Allerød, Denmark. So European roots, but definitely a global player now.
And their core thing, life sciences tools, specifically.
High-precision instruments for cell counting and analysis. That's their bread and butter.
What's the secret sauce, then? What makes their technology special?
Oh, okay. So their unique angle, their proprietary approach, is how they combine fluorescence microscopy with some pretty sophisticated digital image analysis. And they've built this into a really slick automated workflow.
Walk me through that. How does it actually work in the lab?
Right. So you take your cell sample, tiny amount, mix it with a special fluorescent dye. This stuff stains the cell nuclei, makes them light up.
Got it.
Then you load that mixture into their special cassette. It's proprietary, single-use, disposable. That's important.
Okay, the blade.
Precisely. You pop that cassette into their instrument. The instrument captures a digital image of the glowing nuclei, and then their software kicks in, identifies the nuclei, counts them, and even figures out which cells are viable, which aren't.
Okay, so no more squinting into a microscope, clicking a manual counter, hoping you don't lose track.
Exactly. It takes out so much of the human variability, the subjectivity.
And why is that specific value proposition so incredibly important in biotech today, especially cell and gene therapy?
Because consistency and accuracy are everything. Think about it. When you're developing or manufacturing a therapy that's going into a patient, you need to know exactly how many viable cells you have at every single step.
From the very beginning of research?
All the way to the final quality check before it's administered. It's non-negotiable. Their systems are seen as best in class for that consistency, that accuracy, and they're easy to use too, which helps.
So it's not just about saving time. It's about regulatory compliance, patient safety.
Absolutely. For these life-saving therapies, that consistency can literally be the difference between getting FDA approval or facing a major setback.
Makes total sense. Okay, let's shift to that business model you mentioned. The razor and blade. We all know Gillette, right?
Okay.
Buy the razor, keep buying their blades. How does that work for these super specialized biotech instruments?
It works beautifully. It's really the engine behind their commercial success. The core idea is identical. You sell the instrument, that's the razor. It's an initial investment for the customer.
Right.
But that sale locks them into buying the essential single-use consumables, the blades, over and over again. And those consumables carry very high margins.
Ah, so that's where the long-term recurring revenue comes from.
Exactly. It creates this powerful, predictable revenue stream. It's a beautiful model for them.
So if we break down their revenue, it comes from three main places.
That's right. 3 pillars. First, you've got the instruments, the razor. That's the upfront capital purchase for the customer. Things like their nucleocounter instruments or the newer excitomatic line.
And that part's more cyclical. Depends on funding.
Yeah, exactly. Very sensitive to biotech funding cycles, general capital expenditure budgets. When funding is tight, instrument sales tend to slow down.
Okay, pillar 2, the big one.
Pillar 2, consumables. The blades. This is the highly profitable recurring revenue engine. We're talking about those proprietary single-use items, the via to cassette reagents, test kits.
And usage drives this.
Directly. It's proportional to the number of instruments they have out there, the installed base, and how often customers are running tests. This is the stable, predictable part of their revenue. Very high margin.
Got it. And the third pillar.
Services. This adds another layer of recurring revenue and, importantly, boosts customer loyalty. Think annual maintenance contracts, validation services.
Ah, like that FDA compliance stuff you mentioned. 21 CFR Part 11.
Exactly that. Validation and qualification services are critical, especially for customers working in regulated GMP environments. Plus training, instrument relocation help, it all adds up. And naturally, as the installed base grows, the service revenue grows too.
Okay, this model sounds great in theory. But the real test came recently, right? That 2023 biotech winter everyone talks about.
Yeah.
Funding dried up. How did ChemoMetec actually hold up?
Yeah, that was a major stress test. Start mid-2022, you had rising interest rates, economic uncertainty, and biotech funding just contracted sharply.
So their customers, especially the smaller early stage ones,
Slam the brakes on capital spending, big time. And ChemoMetec felt that directly. Their instrument sales dropped, I think it was 17%. In their fiscal year 2022-23.
Ouch. For a company selling equipment, that sounds really bad.
It would be for a pure capital equipment company. But here's where the model shined. While new instrument sales tanked...
The existing ones kept running.
Exactly. The installed base kept working, labs kept doing research, manufacturers kept making batches. So guess what happened to consumable sales?
It went up.
They surged, up 18%. And service revenue jumped even more, 39%.
Wow. So the recurring streams basically saved the day.
Pretty much. They largely offset that big drop in instrument sales. ChemoMetec still managed to post 4% total revenue growth for the year. It's just a perfect illustration of how that installed base acts as a stabilizer. It makes the whole business way more durable.
You can really see that play out in the numbers, like in that table 1, comparing the downturn period to the recovery.
Oh, absolutely. Look at H1 2023-24, deep in the downturn. Instruments were, 31% of revenue?
Yeah.
Then look at H1 2024-25 during the recovery. Instruments jumped back up to almost 35% of revenue. That's like a 42% year-over-year growth spurt for instruments.
Huge swing.
But the key thing, consumables, they stayed the largest chunk throughout, around 42 to 45% of revenue. And even during the tough times, they showed stable growth, nearly 18% year over year. Services were solid too, growing over 22%.
So that recurring revenue base is just rock solid.
It's the bedrock. It gives them that resilience.
Okay, we get the model. Let's talk products. What are these instruments specifically? What do they do?
Well, ChemoMetec is very focused. They don't try to be everything to everyone. They aim for really exceptional performance in their core applications. Their main line, the foundation, is the nucleocounter family.
That's the flagship.
Yeah, market leader, known for precision, being really robust, and that simple load-and-go operation we talked about.
Any particular model that stands out?
The NC22, that's a real workhorse. It brought in something like 36% of their instrument sales in the first half of the last fiscal year. It's become a bit of a standard in cell therapy manufacturing because it's so consistent.
Okay. And there are others in that family.
Yeah, models like the NC250, the NC3000, they offer different levels of automation, catering to various research and quality control needs.
But they're not just sticking with the tried and true. You mentioned the X-Cytomatics platform. That's newer.
Right. Launched more recently, maybe fiscal 23-24. This is their next generation tech. It's designed for applications that need higher throughput processing, more samples, faster.
How has that been received?
Very well, it seems. The first models, the XM30 and XM40, got a lot of market interest. They were actually key drivers in that instrument sales recovery we saw in 2024, especially over in North America.
Interesting. And they're pushing that platform further.
Yes. A big strategic development is the upcoming X-Cytomatic 50. This is designed specifically for microplate compatibility.
Ah, like the standard 96-well plates you see in labs.
Exactly. That format is huge for automated high-throughput screening, bioprocessing optimization, things like that. So the XM50 is aimed squarely at capturing those more demanding segments of the market, customers needing really integrated, automated workflows.
So it shows they're definitely not resting on their laurels. They're innovating, pushing into new areas.
Definitely. Moving up the value chain, you could say.
Okay, so who are the main customers buying these? And where's ChemoMetec focused geographically?
Their commercial focus is laser sharp. They talk about LCB, that's life science research, cell and gene therapy, and bioprocessing. That bucket consistently makes up over 90%, like 92, 93% of their total revenue.
And within LCB, what's the real engine?
Cell and gene therapy, CGT. That is by far the most critical driver for them right now.
Why are their tools so vital in something like CAR-T therapy?
Because in CAR-T, getting the cell count right isn't just important, it's mandatory at every single step.
Every stage.
From the initial research through developing the manufacturing process, monitoring the cell expansion, right up to the final QC check before those engineered cells go back into the patient. You have to know the precise number of viable cells. Their instruments are just indispensable for that.
Okay. And geographically.
Yeah.
Global footprint, but concentrated revenue.
That's a good way to put it. They sell directly in key markets, US, UK, Germany, France, Netherlands, and use distributors elsewhere. But the revenue is heavily weighted.
Towards North America?
Overwhelmingly. US and Canada is the engine room, consistently 58-59% of total revenue. Performance there, especially instrument sales, is like a leading indicator for the whole company's health. It's tightly linked to US biotech funding.
And the rest?
Europe is second, around 32%, and the rest of the world, which includes fast-growing Asia, is about 10-12%.
And again, that Table 1 data really hammers that home. US-Canada bouncing back strong in the recovery, driving the overall growth.
Yep. Their focus aligns perfectly with where the major biotech activity is happening. It's very deliberate.
Okay, that gives us a really solid picture of ChemoMetec itself. Now let's zoom out. What does the bigger industry landscape look like, this whole cell analysis market? How big are we talking?
We're talking big and growing fast. It's definitely a multi-billion-dollar endeavor. Estimates for 2023-2024 put the global cell counting and analysis market somewhere between, say, $9.3 billion and $11.6 billion.
Wow, okay. And the future?
Looks very bright. There are strong secular tailwinds pushing it forward. Projections show a robust growth rate, a CAGR, somewhere in the range of 7.7% to 8.6% over the next 5 to 10 years.
So where does that take the total market size?
By 2029 to 2034, estimates range from $16 billion up to maybe $22.6 billion. It's a significant expansion.
And geographically, does the overall market mirror ChemoMetec's focus? North America leading.
Absolutely. North America is the dominant region, which makes ChemoMetec's heavy focus there very logical. That dominance comes from having a high concentration of pharma and biotech companies, big R&D investments, good infrastructure, all that.
Any other regions growing fast?
Asia-Pacific is expected to be the fastest-growing region. You're seeing increasing healthcare investments there, a booming biopharma sector. So yeah, this isn't some sleepy, mature market. It's dynamic, expanding rapidly, really driven by fundamental progress in science and medicine.
What are those fundamental drivers? What's fueling this growth?
Well, the bedrock, the foundation, is just the overall expansion of cell-based research. Think about cancer research, immunology, stem cells, neurology. All these fields rely heavily on analyzing cells. And unfortunately, the rising incidence of chronic diseases globally just keeps fueling more research in these areas.
Makes sense, but I imagine the really powerful boost comes from the newer therapies.
Oh, definitely. The rise of biopharmaceuticals and advanced therapies, that's probably the most potent tailwind. Biologics, cell therapies like CRRT, gene therapies, their development and manufacturing are critically dependent on precise, frequent cell counting.
For what exactly?
Process monitoring, quality control, final product release, you name it. Cell counters are just indispensable tools in bringing these complex therapies to market.
And you mentioned earlier this shift away from manual methods. That must be a huge plus for automated players like ChemoMetec.
It's a massive, irreversible trend. Manual counting using a hemocytometer and a microscope. I mean, it works, but it's slow, it's labor-intensive, and it's notoriously subjective. Different people get different results.
Yeah, I can imagine.
Automated systems like ChemoMetec's, they're faster, much more accurate, highly reproducible, and they free up skilled technicians to do other things. So that push for automation and better data quality is a direct tailwind for them.
So in this growing, automating market, who else is out there? Who are ChemoMetec's main competitors? What's the ecosystem like?
It's a mixed bag. You can slice the market by product instruments versus consumables. And interestingly, the consumables part is actually bigger, more stable, and growing faster. That really validates ChemoMetec's whole razor and blade focus.
And by customer type.
You've got academic and research labs, pharma and biotech companies. They're crucial because of budgets, regulatory needs, high consumable use, and then hospitals and diagnostic labs, too.
Okay, so who are the actual company names competing in this space? Other big players?
Oh, yeah. You've got the diversified life sciences giants. Think Thermo Fisher Scientific, Merck KGaA, Danaher through their Beckman Culture Life Sciences division, GE Healthcare. These are huge companies with massive product portfolios, global reach, everything.
Okay, and then more specialized players,
Yeah.
closer to ChemoMetec.
Right, that's the other category. Specialized technology players. This is where ChemoMetec fits, alongside companies like, say, Cyclical Biosciences, who are big in high-parameter flow cytometry, or 10x Genomics doing single-cell genomics. There are others, too, like NanoSelect, Azenta. It's a busy space.
And this whole field, it's heavily influenced by technology, obviously, but also regulation. Tell me more about that regulatory unseen moat.
It's huge, especially when you get into the therapeutic manufacturing side. Technology-wise, you've got different approaches. Flow cytometry is great for discovery research high speed, looking at many parameters at once. ChemoMetec's approach, image-based cytometry, is more about precision and consistency for specific critical counts.
And the regulation, that FDA rule.
Yes, GMP, good manufacturing practices, and specifically FDA 21 CFR Part 11. This rule is all about electronic records and electronic signatures. It sets really strict standards to ensure data is trustworthy, reliable, secure, can't be tampered with.
So things like audit trails.
Secure audit trails, user access controls, validated electronic signatures, all mandatory. It's not optional if you're making a therapeutic product or submitting data to regulators. It's a prerequisite for any GMP environment.
And that creates a barrier.
A massive barrier to entry. Competitors can't just build a machine that counts cells. They need a system that meets these incredibly stringent data integrity requirements. It makes ChemoMetec not just a hardware provider, but a partner in process control and quality assurance. Their whole system is built around providing repeatable, documented, validated data for control, not just fuzzy data for discovery. Big difference.
And that reinforces that stickiness factor, the high switching costs.
Absolutely. Once a customer validates a ChemoMetec instrument into their FDA-approved manufacturing process, into their SOPs, their biologics license application, switching becomes a nightmare.
Why? What's involved?
Costly revalidation studies. Comparability studies to prove the new method gives identical result. Amendments to regulatory filings, it introduces risk, cost, massive delays. Companies are just extremely reluctant to go through that hassle. They stick with what's validated and approved.
Okay, here's a really interesting point from the sources. The idea that the high cost of other complex instruments actually helps ChemoMetec. How does that work?
It's a neat dynamic. You often hear that the high initial cost of fancy lab equipment like those multi-laser flow cytometers costing hundreds of thousands is a market restraint. It limits adoption.
Right.
But for ChemoMetec, that restraint becomes an advantage. Their instruments, while sophisticated, are very focused. They do one critical job really well, and they're generally more affordable than those super high-end research machines.
So for a startup.
Exactly. For a cell therapy startup, maybe tight on capital, needing a compliant QC solution, ChemoMetec hits the sweet spot. It does its essential job reliably, meets regulatory needs, and doesn't break the bank compared to the alternatives. So the broader market's restraint kind of pushes customers towards their more focused, cost-effective solution for that specific QC need.
That's a really smart positioning. Okay, we got the market context. Let's nail down ChemoMetec's specific competitive advantages, build that moat picture.
Yeah.
All right, let's really define ChemoMetec's competitive edge. What are the key sources, the pillars that make their business so durable?
Okay, pillar number one has to be their proprietary technology and simplicity of use. It starts with their patented image cytometry approach.
The combination of fluorescence, the cassette, the software.
Exactly. That whole system, the standardized dye, the precision-engineered disposable cassette, the powerful image analysis software it automates, and crucially, de-skills the process.
D-skills, meaning easier for lab techs.
Yeah, it removes a lot of the potential for human error, the subjectivity you get with manual counting. It's load and go. That simplicity ensures you get consistent results, whether it's Technician A on Monday or Technician B on Tuesday, or even across different lab sites. That's huge.
Okay, pillar one, tech and ease of use. Pillar two.
Data integrity and GMP compliance. We touched on this, but it's absolutely central to their moat. Their platform wasn't just adapted for regulated environments, it was designed for them. Full compliance with FDA 21 CFR Part 11 is built in.
And the benefit there is audit readiness.
Audit-ready data. Peace of mind for the customer. It's a non-negotiable feature if you're doing quality control for a therapy going into humans. It's table stakes in their key markets, pharma and biotech.
Makes sense. And Pillar 3 comes back to that business model, right?
Absolutely. The installed base and the recurring revenue model, they have this large and constantly growing global base of instruments out there.
Creating a captive audience for consumables.
Precisely. A captive market for their high-margin proprietary consumables. Each instrument essentially acts like an annuity, churning out predictable revenue year after year. That's what gives them the stability, that cushion we saw during the 2023 downturn.
So how do these advantages shape their actual position in the market? What's their unique value proposition compared to competitors?
They've very cleverly positioned themselves as the gold standard for one specific thing: robust, compliant, and straightforward cell counting.
So they're not trying to compete with the super complex research machines.
No, not directly. They're not going head-to-head with, say, Cytek's full-spectrum flow cytometers that researchers use for deep dives into immunology, looking at dozens of markers. That's a different game.
ChemoMetec's focus is narrower.
Much narrower, but deeper in a way. Their core promise isn't about giving you the most data points possible. It's about giving you the most reliable and defensible answer to one absolutely critical question. How many viable cells do I have right now?
And that specific answer is crucial for
Process control and manufacturing, quality assurance, batch release decisions in regulated settings. It's about having a simple, validated black box that spits out that crucial number with rock-solid consistency.
So they found that sweet spot. Better than manual, but simpler and cheaper than the high-end research stuff for QC.
Exactly. Their automated systems blow manual methods out of the water in terms of reliability and efficiency, but they're less complex and more cost-effective than those fancy research cytometers, which are frankly overkill for dedicated QC work.
And this niche is maybe not attractive enough for the giants to attack directly.
That seems to be the case. It allows ChemoMetec to dominate because maybe the big players don't see enough upside to develop a dedicated, compliant solution just for this, and smaller startups really struggle with the regulatory burden and building that trusted track record.
That's a key insight for you listening. Sometimes being the absolute best at one specific, critical thing, especially in a high-stakes environment like pharma manufacturing, is way more valuable than trying to be broadly capable.
It's a classic niche strategy executed brilliantly.
Okay, which brings us to the really powerful stuff. The barriers to entry and those customer switching costs. This is the impregnable fortress part.
This really is their strongest moat. Prohibitively high switching costs, especially for their pharma and biotech customers. Remember, the cell counter isn't just a piece of lab equipment. It becomes part of a validated manufacturing process that's been approved by regulators like the FDA or EMA.
So once it's baked into the official process,
switching it out is a massive pain. You'd need to completely revalidate the new instrument and method. You'd have to conduct comparability studies to prove the results are identical. You'd likely need to amend your regulatory filings, your BLA, for instance.
Eugene's time, money, risk.
Huge amounts of all three. Risk of delays, risk of regulatory questions. Customers are incredibly reluctant to touch a validated process that works. They will stick with the incumbent provider ChemoMetec unless there's an absolutely overwhelming reason to change. Price alone usually isn't enough.
And the regulatory hurdles themselves act as a barrier for newcomers.
Definitely. Just meeting GMP and 21 CFR Part 11 requirements is tough. Developing validated software with secure audit trails, access controls, it's complex, expensive, and takes time. A new entrant needs not just a working machine, but a fully compliant system, and they need to convince customers it's reliable. That takes years.
Plus, ChemoMetec has built up a reputation over time.
Exactly. Brand reputation and trust. They've been doing this for over 2 decades. They have a reputation for accuracy, reliability, good customer support. In an industry where data integrity is everything, that trust is a massive, hard-to-replicate competitive asset.
Now, I thought this was really clever, the proprietary cassette. It's not just about selling consumables. It's a technical advantage, too.
Yes, this is such a key point. That single-use, pre-calibrated cassette the blade is integral to their technical moat, not just the business model.
How so? What's the technical benefit?
Think about traditional reusable counting chambers. You have to meticulously clean them between samples. That takes time, and there's always a risk of carryover contamination or inconsistencies in cleaning.
All right.
The disposable cassette eliminates all of that. It drastically reduces cross-contamination risk. It removes a major source of process variability. It provides a sealed, sterile, perfectly standardized measurement environment every single time.
And makes it easier to use again.
Yeah.
De-skilling.
Exactly. It guarantees consistency, even with less experienced operators. So the technical superiority for this specific QC application is inherently linked to the recurring revenue model. They feed each other. The business model and the tech moat are really two sides of the same coin.
Brilliant. Okay, powerful moat, great model. How does this translate financially? Let's look at the performance. All right, let's get into the financials. ChemoMetec clearly has a strong story, but does it show up in the numbers? What's their historical track record like?
Oh, it definitely shows up. They have a long-term history of really rapid and, importantly, highly profitable growth.
Give me some numbers. What kind of growth rates?
Well, looking at the 5 years leading up to 2024, they averaged annual earnings growth of nearly 20%, 19.7, I think, and revenue growth averaged over 15% annually during that period. Those are impressive numbers.
And profitability. That's usually where quality really shines through.
Absolutely exceptional. Their net profit margins consistently run in the 35 to 40% range.
35 to 40% net margin. That's huge.
It is. And their return on equity, ROE, has recently been up over 28, even 30%. These kinds of figures tell you a lot. They point to a really strong competitive position, significant pricing power, and a business model that scales incredibly well.
And that table, too, the 7-year summary, kind of shows that journey, the ups and downs.
Exactly. You can see the revenue growth bouncing back strongly after that dip in 2024, the downturn year. Before that, you see that huge 51.9% jump in 2022. And look at the EBITDA margins peaking at an incredible 56.8% in 2023, then recovering to around 45.7% in 2024, even during the downturn. The net margins track that too. It's a powerful profit engine.
Okay, that historical context is strong. But like we discussed, the real test, the real story, is how they handled that recent cycle, the biotech winter starting in 2022, and the thaw that followed into 2024. Let's dig into that.
Yeah, that period is a perfect case study. The downturn kicked off mid-2022. Rising interest rates, economic jitters, it created that funding winter for biotech. And many of ChemoMetec's customers, especially the smaller pre-revenue companies, are very sensitive to funding availability.
So they cut spending.
Drastically. Capital expenditure budgets got slashed.
And the direct hit to ChemoMetec.
Instrument sales, the razor part of the model, they fell 17% in fiscal 22-23. But the real pain was in the first half of fiscal 23-24, instrument sales plummeted 43% year over year.
43% drop. Ouch. Where was that felt most?
Most acutely in their biggest market, U.S. and Canada. Instrument sales there were down 52% in that 6-month period. It was rough.
Sounds like it could have been disastrous. But the model's resilience kicked in.
That's the beauty of it. Even though companies weren't buying new machines, the ones they already had kept running. Research continued. Manufacturing batches were still being made.
So consumables and services saved the day again.
They provided that critical cushion, as the analysts called it. Growth in high-margin consumables and services continued, offsetting a large part of the instrument decline and preventing a really catastrophic drop in total revenue. It just underscores the stability that recurring revenue provides.
Okay, so when did things start to turn around? When did the thaw begin?
Late 2023, early 2024, the biotech capital market started loosening up a bit. Investment sentiment improved. And the recovery for ChemoMetec was fast and strong.
How fast?
Q1 of their fiscal 24-25, total revenue jumped 27% year over year. And that was driven by a massive 61% rebound in instrument sales.
61%. Wow.
Yeah. And that momentum carried through the first half of fiscal 24-25. Total revenue up 26%, instrument sales up 42%. U.S.-Canada really led the charge. Instrument sales there soared 88% year over year.
And the new Excitomatic instruments played a role in that recovery.
Significant contributor, according to the reports. So this whole cycle from boom to bust to recovery, it paints ChemoMetec as a cyclical grower. You've got this strong underlying secular growth story tied to cell therapy, but year-to-year performance, instrument sales are the volatile part, the high beta element. Consumables are the stable foundation, the low beta anchor.
That cyclicality also highlights something else powerful. Yeah. Operating leverage. Explain how that works for ChemoMetec.
Right. Operating leverage just means that a small change in revenue can lead to a much bigger change in operating profit. ChemoMetec has incredibly powerful operating leverage.
Why? What drives that?
Those super high gross margins, consistently over 90%. Most of their costs are relatively fixed R&D sales infrastructure. So when revenue goes up, especially high margin consumable revenue, a huge chunk of that extra revenue drops straight down to the bottom line, to operating profit.
And we saw that leverage work both ways during the cycle.
Perfectly. In the recovery, H1 24-25, that 26% revenue increase turned into a massive 45% jump in EBITDA. The EBITDA margin expanded significantly from 47% to 54%, leverage working for them.
But in the downturn?
Leverage worked against them. In FY 2024, when those high-margin instrument sales fell off and their fixed costs remained, the margins contracted. EBITDA margin dropped from that peak of nearly 57% down to 46%.
So high operating leverage is great on the way up, but it bites on the way down. It makes them very sensitive to those revenue swings.
Exactly. It amplifies everything. It makes ChemoMetec a high beta play on the health of the biotech sector. That's crucial for you, the listener, to understand.
Definitely. Now, alongside that operating leverage, what about their financial foundation? Their balance sheet, cash flow?
Rock solid. The company is a cash-generating machine. Those high margins translate directly into robust operating cash flow and free cash flow.
And debt?
Practically none. Their balance sheet is exceptionally strong and conservative. As of the latest reports, they had a net cash position of around DKK 257 million. That was about DKK 265 million in cash versus only DKK 8 million in debt.
So almost zero leverage on the balance sheet.
Yeah, debt-to-equity ratio is tiny, like 0.01, very high solvency ratio. This financial strength is a huge strategic asset. It gave them resilience during the downturn, obviously, but more importantly, it lets them play offense.
Like with acquisitions.
Exactly. Look at the Ovidio acquisition we'll talk about later. They funded that entirely from cash on hand. No need to raise debt or issue new shares. They could opportunistically acquire key technology because they had the financial firepower.
Okay, so strong financials, proven model, powerful moat. Where do they go from here? What are the growth opportunities, right? ChemoMetec's clearly in a strong position. Looking ahead, where does the growth come from? What are they focused on?
Well, the biggest driver, the primary engine, is still going to be deeper penetration of their core markets, especially within cell and gene therapy.
And why is that sustainable? What keeps that CGT engine running for them?
A few key things. First, the CGT market itself is just expanding rapidly. More therapies are moving through clinical trials, getting approved.
More products reaching the market.
Exactly. Second, even for approved therapies, like CAR-T, they're often moving into earlier lines of treatment, treating patients sooner, not just as a last resort. That significantly expands the potential patient population for each therapy.
Which means higher production volumes.
Much higher. And every time a new therapy standardizes its manufacturing process using a ChemoMetec instrument, boom, that creates another long-term annuity stream of those high-margin consumable sales.
So it's a compounding effect.
It really is. Plus, there's still opportunity, maybe more mature but still present, to convert labs, especially academic or research labs, from manual counting methods to their automated systems. That builds the pipeline for future regulated customers down the line.
Okay, so core market growth is key. What about product innovation? What's cooking in the R&D lab?
They're definitely investing here, enhancing the portfolio, meeting evolving customer needs. A big part of the near-term story is the continued adoption of that Cytomatic platform.
The XN30 and XM40 models.
Right. Those are key growth catalysts right now, driving that instrument sales recovery we talked about. Reports suggest major customers are evaluating standardizing on Cytomatics across their global operations.
But you mentioned a caveat earlier, validation takes time.
Yes, and this is important for you to understand. Management is clear. Validation processes at these big pharma or CDMO sites are comprehensive and time-consuming. So you might not see explosive sales overnight from a big win.
But that lengthy process actually reinforces the moat.
Paradoxically, yes. The fact that it's so rigorous is precisely what creates that incredibly strong lock-in once a customer does validate and adopt the system. Each successful validation basically represents a secure, multi-year revenue stream for ChemoMetec. It's sticky.
Got it. And beyond the current Excitomatic models, they're developing the next one.
Yes, the Excitomatic 50. This is a significant strategic move. Designing it for microplate formats, those 96 well plates targets higher throughput applications.
Like what specifically?
Things like process development, screening large numbers of cell clones, even parts of drug discovery. It opens up new market segments where customers need much greater automation and integration into their existing high-throughput workflows.
So, expanding the addressable market makes sense. But maybe the most exciting strategic move recently was an acquisition. Tell us about Avizio.
Yes, this could be really transformative. In October 2024, ChemoMetec acquired a Belgian company called Avizio Imaging Systems, paid about EUR 2.8 million, all cash.
And Avizio's technology is different.
Very different. Avizio uses holographic microscopy for cell counting, but the critical differentiator isn't just the imaging technique, it's how it's implemented.
How so?
Avizio's system can connect directly to a customer's bioreactor.
Inside the manufacturing tank.
Essentially, yes. It allows for continuous online or inline sampling and analysis during the manufacturing run without breaking the sterile barrier of the bioreactor.
Whoa, okay, that sounds like a big deal. ChemoMetec's current systems are mostly at-line, right? You take a sample out.
Exactly. This moves them from at-line QC, where you manually pull a sample, into the rapidly growing, strategically important field of process analytical technology, or PT.
PT. That's about real-time monitoring during manufacturing.
Precisely. Regulators like the FDA are actively encouraging PAT to build quality into the process, rather than just testing it at the end. Real-time monitoring and control.
So this acquisition gives ChemoMetec a foothold there.
A major foothold. Now they can potentially offer a synergistic package. Use the Avizio tech for continuous in-process monitoring and control inside the bioreactor, and then use their traditional nucleocounter or excitomatic systems for the final at-line batch release QC.
So they could potentially own the entire cell counting workflow.
That's the potential aha moment. From inside the reactor all the way to the final vial, it could significantly expand their addressable market and deepen that competitive moat even further. It's a very smart strategic bolt-on.
That is fascinating. Beyond new tech, what about geographic expansion? Any new frontiers?
Well, North America is clearly the commercial center of gravity right now, but the future opportunities include deepening their penetration in the major European markets, and of course, capitalizing on the really rapid biopharma growth happening in Asia-Pacific, especially China.
So, still room to grow geographically as well.
Definitely. Those regions represent substantial long-term expansion avenues.
Okay, lots of opportunity. But every growth story has risks. Let's pivot to the potential headwinds and challenges ChemoMetec faces. All right, let's talk risks. No companies without them. What are the main potential storms ChemoMetec needs to navigate? What keeps their management up at night?
The biggest one, the most significant risk, and the one we've seen play out already, is their dependency on customer funding. That direct exposure to the cyclical nature of biotech capital markets.
The double-edged sword we talked about. Instrument sales live and die by biotech funding.
Pretty much. The 2023 experience showed it clearly. When funding is flowing freely, biotech valuations are high, customers invest aggressively in new equipment, strong instrument sales for ChemoMetec. When funding tightens, markets get nervous, those same customers delay CapEx sharp decline in instrument sales.
So it really is a leveraged play on biotech health.
Exactly. High beta. Strong sector means ChemoMetec likely outperforms. Weak or out-of-favor sector means that their growth likely suffers, especially on the top line and potentially margins due to that operating leverage. For you, the listener, understanding this inherent volatility is absolutely key. It requires a long-term perspective.
Okay, funding dependency is risk number one.
Yeah.
What else? Competitive threats, technological disruption.
Yes, those are always factors. While their moat is strong, they operate in a space with large, diversified competitors. Think Thermo Fisher, Merck. These giants have enormous R&D budgets, global sales forces, deep pockets.
They targeted ChemoMetec's niche directly before.
Not with the same intense focus, historically. But they could, if they decided strategically to build or acquire a truly competitive, GMP-compliant solution for this specific QC application, they could become formidable competitors. And then there's technological disruption. Cell analysis is a fast-moving field. Someone could, theoretically, come up with a novel detection method, maybe cheaper, faster, more accurate, that could erode ChemoMetec's edge over time. And technologies like flow cytometry continue to advance, always applying competitive pressure.
Okay, so market cycles, competition, tech risk. What about more mundane, day-to-day operational stuff?
Sure, there are practical risks, too. Foreign exchange exposure is one. They earn a lot of revenue in US dollars, over 58%, but have significant costs in Danish kroners. So big swings in the USD-DKK exchange rate can directly hit their reported revenue and profitability.
Makes sense. Any other operational risks?
Maybe customer concentration risk down the line. As the cell therapy market matures, you might see consolidation. Maybe fewer, bigger players, large pharma, big CDMOs. If ChemoMetec becomes too reliant on just a handful of these huge customers, that could increase risk if one decides to switch suppliers, or if one of their major therapy programs fails in late stages. This wasn't quantified in the sources, but it's a general risk to watch.
And supply chain. Always a risk these days.
Always. Supply chain and manufacturing risks. They depend on getting raw materials, electronic components reliably. Any significant disruption there could obviously impact their ability to build instruments or consumables, meet demand, and hit their financial targets.
Understanding these risks definitely puts a spotlight on the people steering the ship. Let's talk about management and governance. Okay, so who is leading ChemoMetec through these opportunities and risks? What can we say about the management team and the board overseeing them?
Seems like they have experienced hands at the helm. The executive team has deep company experience, and the board brings a good mix of relevant skills.
Tell me about the CEO.
Martin Helbo-Behrens took over as CEO in March 2024. Importantly, this was an internal promotion. He was the COO before that.
So he knows the company well.
Very well. He's been with ChemoMetec for a long time and was apparently instrumental in building up their crucial U.S. subsidiary and driving its commercial success. His appointment probably signals a strong focus on continued global commercial execution, especially getting that new Cytomatic line rolled out effectively.
And the CFO.
Kim Nicolip-Silson, responsible for the financial side, reporting, controls.
Okay, and the board of directors. What's the oversight like?
The board looks pretty solid. Experienced average tenure around 4.3 years, which suggests stability but also some fresh perspectives. And they seem to have deliberately brought in diverse expertise.
Like who?
Well, the chairman, Niels Thiestrup, is an attorney, strong on commercial law, capital markets, governance. The deputy chairman, Martin Glensberg, is actually a co-founder, so he brings that deep institutional knowledge, especially around product development, production, business development.
That founder perspective is valuable. Anyone else stand out?
Yeah, Christine Fierce is interesting. She's a project director at Novo Nordisk.
A major potential customer type.
Exactly. She brings deep biology and R&D expertise, presumably a really good understanding of what key customers actually need and how they think. Other board members have backgrounds in strategy, digitalization, sales, and marketing. Seems like a well-rounded group with relevant skills.
Okay, good leadership structure. How do they approach using the company's money? What's their capital allocation philosophy?
Seems quite disciplined and focused on shareholder value. Their top priority is clearly internal investment in R&D to drive organic growth. Developing the Cytomatic platform, the new XM50, that's priority one.
But they're open to M&A.
Yes, but strategically. They seem willing to do bolt-on acquisitions to get new technology or strengthen their market position. Avizio is the perfect example, relatively small deal size, paid all cash, clearly targeting a specific technological gap, suggests a prudent, not overly aggressive approach to M&A.
And what about returning cash to shareholders?
They do that too. They have a policy of returning excess capital via dividends, and they have paid an annual dividend in recent years. Shows a commitment to shareholder returns alongside investing for growth.
Finally, how is this all governed? Transparency. Alignment with shareholders.
They follow the NASDAQ Copenhagen listing standards, publish annual corporate governance and remuneration reports. Seems pretty standard and transparent.
What about executive pay? Is it aligned with performance?
This is a good point. Their executive remuneration policy aims to align management interests with shareholders. There's a variable cash-based bonus component, but it's explicitly tied to hitting specific financial targets, things like organic revenue growth and EBITDA levels.
Does it actually work? Does pay go down if performance dips?
Apparently, yes. The reports highlighted that in the challenging 2023-24 fiscal year, when the company missed some of its targets, no bonus was awarded to the executive management.
Ah, okay, so it has teeth.
It shows a meaningful link between pay and actual business performance. For you, the listener, that kind of transparency and performance-linked incentive structure should provide some confidence that management is being held accountable, suggests responsible stewardship.
That is reassuring. Okay, great business, strong governance. Leads to the big question, how does the market value this? Let's get into the valuation. All right, the moment of truth, the valuation. ChemoMetec sounds like a high-quality company. Does it come with a high price tag? What do the trading multiples look like?
Yes, it definitely trades at a premium. That's been consistent. The market seems to recognize the quality here. Looking at late 2024, early 2025 numbers,
Give me the key metrics. P/E ratio.
trailing 12-month PE was somewhere in the 53x to 60x range,
Wow, okay. Price to sales.
around 19.5x to 22.3x, also very high.
And EV to EBITDA. Often a good measure for profitable companies.
That was running around 40x to 45x.
So across the board, these are pretty elevated multiples, right?
Yeah.
Compared to the general market.
Oh, absolutely. Now, they have come down from the absolute peaks we saw during the crazy 2021 biotech bull market frenzy. But even after that compression, these multiples remain very high, both in absolute terms and relative to the broader market indices. The market has consistently awarded ChemoMetec a premium valuation for a long time.
How does that stack up against its direct peers in the life sciences tool space? Is it an outlier there too?
A huge outlier. When you benchmark ChemoMetec against other publicly traded companies in the sector, the premium is really stark.
Like in that Table 3 comparison.
Exactly. Look at that table. Compare ChemoMetec's EB sales, PE, EBITDA. They're just significantly higher than peers like Azenta, Evotec, 10x Genomics. And notice something else on that table.
What's that?
How many of those peers have negative earnings? Their PE is listed as NM, not meaningful. Meanwhile, ChemoMetec is delivering those 45% plus EBITDA margins and 30% plus return on equity we talked about. They're in a completely different financial league.
So if you just did a simple relative valuation comparing multiples, you'd scream overvalued.
You would. But that would be an incomplete analysis, right? It doesn't account for the vast difference in business quality, profitability, and predictability.
Which brings us to the core question. Is this premium valuation justified? What's the argument for it?
The case for the premium rests squarely on that superior financial profile and the strength of their moat. Those incredible margins, the high returns on capital, they're not accidental. They're the direct result of that defensible niche, the high margin recurring revenue from the razor and blade model, the high switching costs, and their focused exposure to the fast-growing CGT market.
So the market is paying up for quality and predictability.
Exactly. Paying a premium for high growth, high profitability, and high predictability of earnings, especially from that consumable stream. You almost have to view ChemoMetec less like a typical cyclical lab equipment maker and more like a best-in-class vertical market software company with recurring revenue. The market prices in that superior quality and the durability of their earnings stream.
Okay, that's the bull case for the valuation.
Yeah.
What's the case for caution? Why might it be too expensive?
Well, the flip side of a premium valuation is that there's very little margin for error, very little margin of safety. The stock is priced for continued execution excellence.
So any slip-up could be costly.
Any significant slowdown in growth, any unexpected pressure on those high margins, any strategic misstep, it could lead to a really rapid and severe derating of that high multiple. Investors could lose patience quickly.
And that inherent cyclicality is still a risk factor for the valuation.
Absolutely. Paying a peak multiple for a cyclical grower is always risky. If the biotech funding environment sours again, like it did in 2023, the multiple could compress significantly, even if the long-term story remains intact. And as you mentioned, at least one discounted cash flow DCF analysis suggested the stock might be trading above its intrinsic value based on reasonable future cash flow projections.
So for you, our listener, this is really the crux of the investment decision. You've got this exceptional business quality, the strong moat, but it's potentially offset by the inherent cyclicality in that demanding valuation.
Yeah.
Is the quality worth the price?
That's the million-dollar question, or perhaps the multi-billion-dollar market cap question here. It highlights that true quality often comes at a high price in the market.
Okay, we've taken a really deep dive into ChemoMetec. Let's bring it all together. What are the potential catalysts that could push this company and its stock to outperform even these high expectations? What could drive it higher?
I think the most powerful near-term catalyst would simply be a sustained strong recovery in biotech funding. If that funding environment stays robust or even accelerates, that translates directly into more CapEx spending by their customers.
Driving instrument sales higher than expected.
Exactly. Higher instrument sales combined with that strong operating leverage we discussed could lead to significant earnings beats versus analyst forecasts. That often gets a stock moving.
What about company-specific catalysts, beyond just the market tide lifting the boat?
A big one would be news of major customer standardization on the Cyclical platform. Imagine a press release saying, A top 5 pharma company, or a major CDMO, has chosen Cytometec as their global standard for QC in a newly approved cure-RT therapy.
That would be huge validation.
Massive validation. It would lock in significant long-term consumable revenue and likely trigger a wave of adoption across the industry as others follow the leader. That would be a very positive catalyst.
And the Ovisio acquisition. Could success there be a catalyst?
Definitely. Successful commercialization of the Ovisio technology. If they start showing early evidence of integrating that holographic microscopy, that inline PIT capability successfully, getting traction with customers, that could really change the narrative.
How so?
It could force the market to reevaluate ChemoMetec's total addressable market, maybe assign a higher long-term growth rate because they're now playing in that bigger PIT space. That could justify a higher valuation multiple.
Okay, those are the potential upsides. What about the downside? What could realistically hold the stock back or cause it to underperform?
The biggest threat, hands down, is the reverse of the first catalyst, a renewed downturn in biotech funding. Given how sensitive their instrument sales proved to be in 2023, another biotech winter would almost certainly repeat that pattern: pressure on revenue, pressure on margins, and likely a significant derating of the stock's multiple.
What about execution risks?
Always a factor: execution and integration risks. Their growth story relies on successfully rolling out the Cytometec line globally and integrating and commercializing the Ovisio technology. Any significant delays, technical hiccups, or integration challenges could lead to growth shortfalls versus expectations, and investors would likely punish that.
And competition. Could someone finally crack their niche?
It's possible. Increased competitive intensity. While the moat is strong, it's not infinitely high. If a major competitor, maybe one of those giants, were to launch a good enough, fully GMP-compliant alternative at a significantly lower price point, that could introduce real pricing pressure and start to chip away at ChemoMetec's market share. That's a risk to watch.
Okay, let's wrap this up. Final synthesis. What's the big picture takeaway on ChemoMetec AS?
I think the overall assessment is pretty clear. ChemoMetec is truly a best-in-class operator. They've built a dominant position in a really attractive, structurally growing niche market cell counting for regulated biotech. They have a formidable competitive moat, primarily built on those extremely high switching costs in validated GMP environments.
And the financial results reflect that.
Absolutely. Exceptional profitability, high returns on capital, strong and predictable recurring cash flows, especially from consumables. It's a high-quality business profile.
But there's always a but, isn't there? What's the nuance here?
The nuance is twofold. First, their fortunes are undeniably, inextricably linked to the health of that volatile biotech funding environment. That introduces cyclicality that you just can't ignore. Second, as we just discussed, the market knows this is a quality company, and its valuation consistently reflects that, trading at a substantial premium.
So for you, the listener, making an investment decision here requires balancing these factors.
Exactly. It requires real long-term conviction in the growth runway for cell and gene therapy. It requires a tolerance for that biotech funding volatility. And it requires making a judgment call on whether that superior business quality truly justifies the premium price tag the market demands.
And that Ovisio acquisition adds another layer of complexity
Right.
or opportunity to that calculation.
It really does. It adds a new, potentially transformative growth angle, the move into PAT, that might not be fully baked into the current valuation yet. It adds another dimension to the story.
We've really explored ChemoMetec's laser focus, how they carved out this deep moat in a critical biotech niche. But here's a final thought for you to chew on. In this world of incredibly complex science, dazzling discoveries, how often is real, durable innovation and market dominance found not in the absolute flashiest new tech, but in just making a fundamental, critical, maybe even seemingly simple process flawlessly reliable?
Yeah, mastering the basics, but at an industrial validated scale.
Exactly. And what might that tell us about other unseen foundational technologies out there, the ones quietly powering tomorrow's big breakthroughs? We hope this deep dive has given you a whole new perspective on the life sciences tools market and the surprising power of niche specialization.
Keep digging, keep learning.
And we'll catch you on the next deep dive.